In the last two videos, we covered the basics, what corporate finance is, and what a company is actually trying to achieve. Moving forward, we need to understand how to look at a company's financial health itself. For instance, if someone were to put a business in front of you right now and ask, is this company healthy? Where would you even start in the first place? You could look at how much stuff they own. You can also look at how much they made last year. Or you could even look at how much debt they're carrying. All of that is actually correct, and they actually just live in two documents, the balance sheet and the income statement. So that's exactly what we're going to be covering today. Every company has them, and once you know how to read them, you'll never look at the business the same way again. Let's get into it. Before we begin, let's work through our business together from scratch. Let's say we want to open a Malatang restaurant because Ashore really likes to eat spicy food. We need to scrap together our savings, take out a bank loan, sign a lease, buy equipment, and stock the kitchen. And we have run this restaurant for a year already. Having all of this in mind, let's begin with the balance sheet. The balance sheet is a snapshot of the firm's financial health. It is like a photograph taken on one specific date. The goal of it is to answer three questions at once. What does the firm own? We call these the assets. What does the firm owe? These are the liabilities. And what's left over for the owners? This remains after all the debts are accounted for. That's the owner's stakes, their equity. Now the balance sheet is always laid out the same way. The left side of the equation lists all the assets. The right side lists all the liabilities and the owner's equities. And this is a rule that never breaks. Assets equals liabilities plus shareholders' equity. This is also called the balance sheet identity. It's always true because shareholders' equities is literally defined by the difference between assets and liabilities. If the two sides didn't balance, the math would just be wrong. Let's explore both sides of the equation, starting with the left side first. Assets. Assets are split into two types based on one thing, time. The two types are current assets and fixed assets. Let's begin with the current assets. These are the things that will be converted into cash within the next 12 months. They are short-lived by nature. And for our Malatang example, current assets include cash, the money in our register, and our bank account. Next, we have accounts receivable. Our Malatang does catering on the side. We catered a corporate lunch last week and sent the client an invoice, but they haven't paid it yet. That money owed to us is a current asset. It's not cash yet, but it will soon be. Lastly, we have inventory. All the ingredients in our kitchen right now, the rice, the sauces, the proteins. We will use these and restock them constantly over the year. Now within current assets, notice that they're listed in order of liquidity. Cash first, then receivables, then inventory. We'll come back to why liquidity ordering matters in a moment. Now let's go back to fixed assets. These are things that have useful life greater than 1 year, used to generate revenue over time rather than be converted into cash for the normal course of a business. And there's also two different types of this, beginning with tangible fixed assets, physical things you can touch, Malatang stoves, refrigerators, tables, and chairs. These will serve the restaurant for years. And we also have intangible fixed assets, no physical existence, but real value. The Scalify Hatch Malatang brand name, a secret recipe we trademarked, a licensing agreement. We can't hold them, but they absolutely show up on the balance sheet. And this covers the entire left side of the equation. Now let's flip to the right side. Now for the right-hand side, it includes liabilities and equity. Starting off with the liabilities, like assets, they're also split by time, current versus long-term. The current liabilities are debts we had to pay within the next year. It includes accounts payable, the money the business owes to suppliers for goods or services received, but have not yet been paid for. An example for our Malatang restaurant is that we ordered ingredients from our food supplier last week on credit. We haven't paid yet. That's money we owe that is due soon. There's also notes payables, which are short-term borrowings from a bank or lender that must be repaid within the year. And these are the current liabilities. For our long-term liabilities are debts that are not due for more than a year. The big one here is the bank loan we took out to open the restaurant. If it's a 7-year loan, the portion not due this year sits here as the long-term debt. And finally, we have our shareholders' equity. Think of it this way. If we sold every single asset today and used that money to pay off every single debt, whatever cash remained will belong to us as the owners. That remainder is our equity. Thinking back to the balance sheet identity equation I showed you before, it is equity equals assets minus liabilities. It's the same formula, just rearranged, and it always holds true. Before we move on, there's still one more term from the balance sheet worth knowing. Net working capital. Net working capital equals current assets minus current liabilities. It's actually pretty simple. It's the difference between what's going to convert into cash in the next year and what we have to pay out in the next year. For a healthy business, this number is almost always positive, meaning more cash is coming in than going out in the short term. That's financial breathing room. Say our Malatang restaurant has $40,000 in current assets and $15,000 in current liabilities. Our net working capital is $25,000. That's a comfortable breathing space. However, a negative number means a warning sign. It shows that the business might not be able to cover its short-term obligations when they come due. Okay, so now that we know what the balance sheet looks like, there are actually three things to think about when we're reading one. Let's go through each one together. The first one we have to go through is liquidity. We mentioned before that assets are listed in order of decreasing liquidity. But what does that actually mean? Well, liquidity is the speed and ease at which an asset can be converted to cash without a significant loss in value. Most importantly, we can actually convert any asset to cash quickly if you just drop the price low enough. However, true liquidity means you can do it quickly and get close to what it's worth. And these are the two most important traits of liquidity. Here's how that plays out for our restaurant. Cash is perfectly liquid because it's already in cash. And then we have accounts receivable, which are close enough to liquid. The money is coming, just not yet. And then we have inventory, which is the least liquid current asset. It has to be cooked, served, and paid for before it becomes cash. And finally, we have fixed assets that are even less liquid, because those stoves and refrigerators generate cash over time, but converting them quickly means selling at a loss. And finally, here's also a trade-off. Liquidity is valuable, but it comes at a cost. The more liquid an asset is, the less it tends to earn. Cash sitting in a register earns zero return. So there's always a tension to manage. Stay liquid enough to pay your bills, but don't leave so much sitting idle that you'll be leaving profits on the table. Moving on is debt versus equity. Here's something important about how liabilities and equity work together. When a firm borrows money, those creditors, that include the banks, the bondholders, get first claim on the firm's cash flow. They get paid before anyone else. Equity holders are last in line. They get paid whatever is left after every creditor has been paid. That's why shareholders' equity is also called the residual claim. The implication here is that the more debt a firm carries, the riskier the equity becomes. Because if things goes wrong, the creditors are protected and the shareholders absorb the loss. The use of debt in a firm's capital structure is also called a financial lever. Think of it as an actual lever. For example, our Malatang restaurant took out a $200,000 bank loan to open. If the restaurant does well, we have lines out the door, catering gigs, regulars coming back. That borrowed money helped us build something far bigger than our own savings could have funded. That amplified our gains. But if the restaurant struggles, including slow months, unexpected costs, a bad winter, that loan payment is still due every single month, whether or not a single customer walks through the door. Now the debt is actually amplifying our losses. So the main point here is that more debt equals higher potential reward. More debt also equals higher risk of financial distress. Both are always true at the same time. Finally, the third thing to look for is the book value versus the market value. This is a really important concept. The numbers you see on the balance sheet are called the book values. Under GAAP, generally accepted accounting principles, assets are recorded at historical cost, but we actually pay for them for the price at the time we bought them, not what they're actually worth today. Here's what that looks like for our restaurant. We bought kitchen equipment for $50,000 when we opened. 3 years later, after depreciation, the equipment shows up on the balance sheet at $20,000. That's the book value. But if a supplier walked in today and said, "I'll buy all your kitchen equipment for $35,000, that's the market value. Same equipment, two very different numbers. Now here's what gets really interesting. Some of our most valuable assets don't appear on the balance sheet at all. These are the hidden assets. Our reputation, our loyal regulars, the fact that people walk past other restaurants to come to ours, the brand name people recognize and trust. None of that shows up. GAAP doesn't record what has never been purchased at historical cost, but those are still important. Now, for a financial manager, market value is what matters. Always. A change in accounting rules might shift the book value overnight. but it has zero effect on what the asset is actually worth. Market value depends on the cash flows that business generates and the risks involved in generating them. So now that we know what our Malatang restaurant owns and what it owes as of one specific date, we need to understand that a photograph can only tell you so much. To understand how the business is actually performing, whether it's growing, whether it's profitable, whether it's earning more than it spends, we need something different. We need the video. This is also the income statement. If a balance sheet is like a photograph taken on one specific date, the income statement is like the video recording that plays between photographs. It covers a period of time, usually a quarter or a full year, and it answers one central question. How did the business perform? The equation is income equals revenue minus expenses. Everything on the income statement is a more detailed version of that formula. So let's actually build the Malatang restaurant's income statement for its first full year together. The very first thing we have is net sales, or revenue of $500,000. Every dollar that we earn from dine-in customers, catering gigs, and delivery over the years is included. This is the very top line. After that, we need to reduce the cost of goods sold. The direct cost of producing what we sold, ingredients, broth, packaging, the cost embedded in every bowl we served. This comes off first. That leaves us with $320,000, sometimes called the gross profit, which is essentially revenue minus the direct cost of making it. After that, we have to subtract depreciation. So I would need to explain this a bit more. When we opened the restaurant, we brought $50,000 worth of kitchen equipment. That $50,000 left our bank account on day one, but the equipment doesn't get used up on the first day. It serves the restaurant for years, cooking thousands of bowls of malatang, generating revenue over time. So an accountant asked, should we record the entire $50,000 as expense the day we brought it, or should we spread that cost over the years it helps generate revenue? The answer is to spread it out, and this is called depreciation. If we depreciate straight line over 5 years, meaning the same amount each year, that's $50,000 divided by 5, which equals $10,000 per year. Here's the critical insight. Depreciation is not a cash outflow. The cash already left. It left on day one when we bought the equipment. Depreciation is just an accounting entry. It spreads the cost of the asset across the years it produced revenue. This is called the matching principle. Accountants match the expense of an asset to the time period it generates revenue. It makes the income statement more accurate over time, but it also means that the income statement is not the same as a cash flow statement. We'll come back to exactly why that matters in the next episode. For now, just remember this. Depreciation shows up as an expense, but no cash goes out the door when it's recorded. Now let's go back to the income statement. After cost of goods sold and depreciation, we get EBIT, earnings before interest and taxes, of $310,000. EBIT is the operating profit of the business, before we account for how it was financed and before taxes. It tells us how the operations themselves are performing, independent of any capital structure decisions. Next comes interest paid, of $20,000. This is the annual interest on our bank loan. Notice how it comes after EBIT, because interest is a financing expense, not an operating one. It exists because of how we funded the restaurant, not because of how we run it. Keeping it separate lets us evaluate the operations on their own. Following that, we have taxable income of $290,000 and taxes of $60,000 and $900. We'll also go deep on taxes in the next episode. For now, we'll just keep it at the current corporate rate of 21%. Finally, we have our net income of $229,100. That's the bottom line. Everything that remains after every expense, every interest payment, and every tax obligation that has been met. We built the entire income statement. After building the income statement, we now have our net income. But it doesn't just disappear. It gets split two ways. Part of it goes to dividends, cash paid out to shareholders. If our restaurant has investors who backed us up early on, dividends are how we reward them for that investment. The other part goes to retained earnings. The portion kept inside the business, reinvested to help it grow. Now here's a quick clarification because this is where the balance sheet and the income statement connect. Shareholders' equity isn't just one number sitting on the balance sheet. It's actually made up of two parts. There's money investors put in directly when the business was funded. And there's retained earnings, the running total of every dollar of profit the business has kept since the day it opened. So when we say $179,000 and $100 gets added to the retained earning, here's what that actually means. The retained earnings balance inside the equity grows by that amount this year. If our restaurant started the year with $100,000 already sitting in retained earnings, and now has 279,100. The increase is exactly what makes total equity grow. This is the real link between the two statements. Net income isn't just a number that appears and disappears at the end of the income statement. It flows directly into the balance sheet year after year, building up the owner's stakes in the business. Every profitable year, retained earnings grow. Pay a little in dividends, keep a little inside. And that key piece is what compounds over time. One document feeds the other. This is just like the balance sheet. There are three things to keep in mind when reading an income statement. The first to look out for is called GAAP timing. Under GAAP, revenue is recognized when a sale is made, not when the cash arrives. The formal name for this is the recognition principle. Revenue is recorded when the earnings process is essentially complete and the value of the transaction is known, which in practice usually means at the time of the sale. Let's say our restaurant caters a corporate event in December and sends an $8,000 invoice. That $8,000 shows up as a revenue this year, even if the client pays in January. Expenses work the same way. Under the matching principle, expenses are recognized in the same period as the revenue they help generate, not necessarily when cash changes hands. The result is, the income statement tells us the accounting story of the business, not always the cash story. And this is the importance of this gap. The second thing to keep in mind is non-cash items. We have already saw the biggest example is depreciation. Depreciation shows up as an expense on the income statement. It reduced net income, but no cash left the building when it was recorded. The cash left on the day we bought the equipment. This is the fundamental reason why net income is not the same as cash flow. A business can report positive net income and still be running short on cash. Or it can report a paper loss but have strong cash flow, because large non-cash charges are dragging down the accounting number without touching the bank account. The last thing to keep in mind is how costs behave over time. It helps to think of the future in two horizons, the short run and the long run. In the long run, every cost is variable. Given enough time, we can sell assets, pay off loans, renegotiate our lease, restructure the whole operation. Everything is adjustable. In the short run, some costs are effectively fixed. They're due no matter what. Our restaurant's rent doesn't care whether we have a packed Saturday night or empty one. The loan payment doesn't care about how many bowls of malatang we sold. Other costs remain variable even in the short run. Ingredients costs go up when we serve more customers. Hourly staff wages can be adjusted with the schedule. Now here's the issue. The income statement doesn't cleanly separate these. Accountants group costs into two buckets. The first is product costs. Raw materials, direct labor, manufacturing overhead get reported as cost of goods sold. There's also period costs. Expenses tied to a specific time period like administrative salaries and rent get reported as selling, general, and administrative expense. Both of these buckets contain a mix of fixed and variable costs. Cost of goods sold has both, and so does selling, general, and administrative expenses as well. The income statement doesn't label which is which. As a financial manager, you need to know the difference, because when revenue drops, you need to know which costs you can cut and which ones are locked in. And you can't get that answer from the income statement alone. You have to know the business. We will definitely cover more of this in the future when we're learning about accounting. Finally, one more concept before we wrap up, because you'll see this number everywhere. Every earnings report, every stock app, every financial headline. That number is earnings per share. Earnings per share equals net income divided by total shares outstanding. Here's the idea behind it. Net income tells you how much a company made in total, but total profit alone doesn't tell you much if you're an investor, because it doesn't tell you what that profit means for your piece of the business. That's exactly what earnings per share does. It takes the company's total profit, divides across every single share outstanding, so you know exactly how much profit is attached to the single share you own, or might buy. So for our Malatang restaurant example, we have 100,000 shares outstanding and a net income of 229,100. Using the formula, the earnings per share comes out to be $2.29 per share. So if you owned one share of Scalify Hatch, $2.29 of this year's profit belongs to you. And we can do the same for dividends. Dividends per share equals dividends divided by total shares outstanding, and this comes out to be 50 cents per share. That's the actual cash you receive per share this year. But here's why this number matters so much. A company earning $1 billion sounds massive until you find out that it has 20 billion shares outstanding. That's only 5 cents per share. Meanwhile, a smaller company earning 50 million with only 10 million shares outstanding is generating $5 per share, over 100 times more profit per share, despite making a fraction of the total profit. That's why investors just don't look at the total net income. Total profit tells you the size of the company. Earnings per share tells you how much of that profit is actually yours. It's a number that lets you compare a massive company and a tiny one on equal footing, and it's one of the key inputs into figuring out whether a stock is actually worth what's trading for. And now that concludes everything we learned in this episode. We learned about reading the two documents that tell you whether a business is actually healthy, the balance sheet and the income statement. We built both from scratch using our Miletown restaurant example. The balance sheet gave us a snapshot of the business on one specific date. Everything it owes as assets, split into current assets like cash and inventory that convert quickly, and fixed assets like equipment and our branding that sticks around for years. Everything it owes as liabilities, split between what's due soon and what's due later. And what's left over for us as owners, our equity. Along the way, we picked up net working capital as a quick health check. We also learned that liquidity always comes with a trade-off against earning potential. We saw how debts acts as a lever that amplifies our wins and our losses. And probably the most important idea in the whole episode, learned that the numbers on the balance sheet are historical costs, not what things are actually worth today, which is why market value is what really matters to a financial manager. And then we move from the snapshot to the video, the income statement, which tracks performance over the whole year rather than a single date. We built it line by line, watched depreciation quietly spread the cost of our equipment over time, without any cash leaving the building, and landed on net income. But net income doesn't just vanish once it's calculated. It's split into dividends paid out to shareholders and retained earnings kept inside the business. And that's exactly where the two statements shake hands. Retained earnings is just one of the two pieces that make up our equity. So every profitable year, our net income physically grows the balance sheet through that retained earnings line, compounding year after year. We also close out on three things to watch out for an income statement. GAAP timing, which means revenue shows up before the cash actually does. Non-cash items like depreciation, which is the whole reason net income isn't the same thing as cash flow. And the fact that fixed and variable costs get buried inside cost of goods sold, and selling, general, and administrative expenses without ever being labeled. And finally, we have earnings per share, which takes out all that total profit and slices it down to what it means for a single share, letting you compare a massive company and a tiny one on the exact same footing. Two documents, two different jobs, one frozen in time, one moving through it, but permanently linked through that one number that flows from the bottom of the income statement straight into the balance sheet. And that's exactly it for today's video. Thank you so much for watching. I'll see you in the next.